It is Monday. It's time to do a show. All right. So we have our guest today, who happens to be a neighbor of sorts. But I'd like to welcome to the show Mr. Greg Wareham, and he is from Your Mortgage Process. Greg, thanks for being on the show. Can you tell our viewers a little bit about yourself and what is Your Mortgage Process?
Yeah, good morning, Steve, David. Thank you for having me on the show. So just a quick background on me. I've been in the mortgage industry for about 25 years. And a couple of years ago, we just decided to start a podcast to better educate the consumer and people in real estate related fields as to what goes on behind the scenes, from high-ranking real estate agents to insurance companies to hedge fund managers, just trying to give people an idea of what type of information that they need to make better educated decisions if you're a home buyer or you're part of the real estate business channel. So we've had a lot of fun with it.
So that sounds like a podcast that I'm more inclined to listen to than what Steve was putting on the table earlier. But tell us a little bit about what's happening in the mortgage world today.
Well, it's certainly been a little bit tumultuous. I mean, when you look at, as we all know, interest rates have been trending upwards since last year. And if there was one word I'd use to describe what's going on, it's volatility. When you look at the bond market and the stock market, we've seen these extreme volatility swings one way or the other. And mortgage interest rates are really driven by the bond market. And if there's one thing the market hates, it's extreme volatility. And people are uncertain as to whether or not we're going into a recession, whether or not the economy is healthy. And there's mixed signals from both sides of the aisle. And as a result of that, you've seen some swings in interest rates. I mean, we've seen them swing anywhere from the high fives to the low sevens over the course of the past 10 weeks. And that's unusual. We usually will see 1/8%, 1/4% swings. We've had days where you can see things swing pretty aggressively one way or the other.
What are some of the challenges that prospective home buyers are facing to secure affordable loans right now? What's coming next? Is there any glimmer of hope?
Yeah, that's a great question, Steve. I mean, as far as interest rates are concerned, it depends on who you ask. There's some speculation that we'll see interest rates start to trend downward by the end of the year. When I say downward, do we get back into the low sixes, potentially the high fives? I was talking to a friend of mine that runs the bond market for Goldman Sachs, and his perspective on it was we're not going to see anything change this year. So a lot of it depends on who you ask. When I look at things from a homeowner standpoint, one of the things that we've seen become commonplace is the waiving of somebody's appraisal. That can create some challenges depending on, when you have a loan in process and you have an appraisal done to the property, what it appraises for. Some people are waiving their rights to be able to renegotiate. We're seeing some issues in that area.
So how does that actually really impact the homeowner when they take that decision to waive the appraisal, for example?
I'll give you a great example on it, David. Let's say someone's buying a house for $500,000 and they're putting down 10%. That's $50,000. That means that you're borrowing $450,000, 90% of the value of the property. Well, let's say that property appraises for $475,000 and the buyers waive their right to renegotiate that price. Well, now the bank's only going to lend on the lower of the appraised value or the purchase price. So in that situation, they either need to come up with an additional $25,000 or they can look to borrow a higher percentage of the value of the property. So in our example, they were putting down 10%, borrowing 90% of the value of the property on a $500,000 purchase with a $500,000 appraisal. But if it comes in at $475,000, now you take that $450,000 loan they were doing, divided by $475,000, they end up borrowing 95% of the value of the property. The big difference for the consumer is, does it impact their rate? And what does it do to their PMI or private mortgage insurance? Because that number will go up. So it's not necessarily something that would kill a transaction. The key is to make sure everyone's educated up front when the consumer decides to go down the path of waiving their rights to the appraised value of the property and renegotiating.
So whose decision is that to waive the appraisal?
So it comes down to the buyer saying,
okay,
do I waive my right to the appraisal? And again, it doesn't mean that they waive their right to having an appraisal done, because the bank's always going to require an appraisal. Really what they're doing is they're waiving their right to renegotiate the price of the property in the event that the appraisal comes in lower than what they're paying for the property.
Got it. Okay. Got it.
In normal market, you really don't see that. in a balanced buyer and seller market. You don't see a lot of that, but it's become relatively commonplace over the course of the past couple of years, and it'll eventually fade out as this market starts to stabilize.
You expecting to see that trend to ease off a little bit in the future, but now how big is the hurdle for home buyers? Obviously, they're shooting themselves in the foot, right?
You potentially can be, right? So if you're waiving the right to the appraisal and the appraisal comes in lower, you're overpaying for the property. It's not necessarily a bad thing. It depends on what your long-term plans are. I mean, if you're planning on purchasing a home and selling it in 2 years, well, if you're overpaying for the property, you may not make your money back.
Is this a product of low inventory? Is this people are in a rush to secure funding?
Steve, it's really the imbalance of supply and demand. So you have a lot of people still actively looking to purchase a home with limited inventory. When supply is really low with a high demand, it increases the price, and it's pushing up the price. And in this situation, it's changing terms, where an appraisal is something that you waive, but in this market, it's become kind of commonplace.
So from a homeowner's perspective, waiving the appraisal, is that really a bad decision? Is it going to have negative consequences down the road?
Yeah, short term, Steve, it can be an issue. If you're overpaying and you're trying to sell a house in a couple of years, it's hard to recuperate the loss. But long term, when you look at real estate since 1991, the average year-over-year return in that time frame is 4.5% on real estate. Oh. So planning on being in the house for a 10-year time frame, you're never going to lose. When you look at the tax advantages that you receive, 4.5% statistical increase year over year, you're just not going to be able to go wrong with it.
All right, so Greg, you were talking about some volatility in the market, and there's lots of things that happen that maybe not your average consumer is aware of. Do you have any insight as to what's going on? Maybe from government standpoint or from tax liability standpoint, anything that's in the works right now that maybe helps sellers or even buyers as well?
Sure, there's actually two different things where the government got involved. So on the buyer side, they've tried to incent people to purchase homes that are first-time home buyers that have really been priced or termed out of the market over the course of the past few years. Lower down payments with lower interest rates to make housing more affordable. But it doesn't really fix our supply issue. So there's something right now they introduced to Congress, which is to change the way you're taxed on the sale of your primary residence. So right now, if you sell your primary residence and you take all that money and you buy another house, there's no tax liability. But if you were to try to keep that money in your pocket and you're a married person filing jointly, you can only keep the first $500,000. That difference taxed on or has to go into real estate. So the bill that's been proposed to Congress right now is to take that ceiling of $500,000 for someone filing jointly and take it to $1 million, which obviously is a huge difference. So now you could sell your house, keep $1 million of it tax-free. The goal is, hey, can we stimulate more people to list their houses for sale? They put this limit. So right now it's $250,000 for single filing, $500,000 for joint filing, but they did this in 1997. Yeah. So obviously the market's changed pretty significantly since then. So it's probably about time that they increase those caps.
Okay. I got it. All right. We're running a little short on time, Greg, but I want you to tell our viewers about your podcast. So there's a lot of good information, and we can have this conversation for a very long time, but we only have a little time here. So how do we hear about your show? How do we get more information from you, Greg?
So if you go to yourmortgageprocess.com, go to that site, it's going to explain what it is that we're doing from the educational standpoint to some of the philanthropic things that we're trying to do for the community. Our whole goal's always been education and interviewing of people that try to help and educate someone looking to purchase a home or real estate professionals. You can download us on Spotify. We're on Apple. The podcast is. We have a YouTube channel. So all sorts of different venues that you can either watch the show or listen to the show. So we certainly appreciate if you check it out, yourmortgageprocess.com.
All right, Greg. Well, thank you so much for coming and sharing with us. And we hope to see you guys next week on the next episode of Community Association Car Chat. We'll see you guys.
Thanks so much, guys.